So, if you raised $1 million from your investors and, that it was 10 investors and they each had $100,000 and you gave them the option of, hey, we can keep this 12% cash on cash return. We're giving you 12% every year. We can keep that going, or we can give you all of your money back, but we'll give you a return that would equate to 8% on your investment. Mm-hmm. So they would say, wow, I get all my money back, so I can invest that somewhere else, and you're still going to give me 8% as if you had my money, and we get to keep the asset and pay down the debt and let it appreciate some more. They're going to be like, yeah, sign me up, do it. Okay, welcome back to How to Invest in Commercial Real Estate. Today is all about how to evaluate a refinance. So when you're looking at a refinance, you're talking about the debt. And the debt is so important because typically it's the majority of the money. When you're talking about the capital stack, if a property costs $1 million, you're probably getting $700,000 or $800,000 from a bank. So you need to monitor that. It's not just, put it on autopilot. It's a 30-year note, or it's a 5-year note, or it's a 10-year note. You don't think about it. It's the majority of the money to buy your property, and little savings and watching it and monitoring can have a lot of benefit, and that's what we're going to get into today.
Yeah, and it's important to just go over the different kinds of debt, because there are debt instruments that are fixed for 10 years, 15 years, and they're really expensive to pay off. And so you don't have a lot of options with Fannie, Freddie, or with CMBS debt in order to pay that off, because the penalty would be drastic. Now, let's say I get one of those types of debt and the interest rates fall and I want to take advantage of that. Well, that's going to make it really expensive to pay off, because what they do is they take that money and they have to go buy Treasury for the remaining term, and the difference between your note and that is what you have to pay over the full length of the term left. Now, that may have been a little confusing, but in essence, whenever it's advantageous to pay off one of those loans, the penalty is going to be really big to pay off one of those loans. So,
right.
But there are plenty of types of debt, and it involves banks usually, where you will have an opportunity to make a change and pay off debt, refinance, lower your interest rate, all that.
So why do you refinance? Are you refinancing because the debt market, all of a sudden you can get a quarter of a point or a full point or whatever less? Is that the only reason you're refinancing? Why are you refinancing?
Yeah, so let's ignore rate just for a second. We'll put a pin in that. It's not just about saving money on the amount of interest you're paying the bank. It could be amortization. It could be, the amount of debt you're putting on a property. So, initially you're buying this deal. It has $500,000 in net operating income, or it's a $5 million deal, and you go put an 80% loan to value on that $5 million deal. Mm-hmm. Well, if you keep it a few years and you had a really good few years, and the income and the rents on the tenants went up like you were projecting, and because of that, it makes more money, and because of that, it's worth more, and now you may have a $7 or an $8 million building. Mm-hmm. Well, you could look at this time potentially getting more debt on the property because it's making more money, so the property can afford more debt. It can still pay it month over month and cash flow. And you could potentially give your investors, some or all of their money back and keep the asset.
Right.
And that's kind of the ultimate win, I think, for us. If you would buy that asset again and again and again, like today, if you ask yourself, hey, do I still want to own this? If it's not like 100,000 square foot Kohl's or something, like you want to keep it. It's a great investment. You like the asset class. Your investors like it. The idea of refinancing it and pulling your money out and letting the property continue to just pay down that debt and keep it in perpetuity and give your investors monthly or quarterly cash flow, that's a win. That's a massive win.
Mm-hmm. So it might be that you refinance, your debt amount, your monthly debt might go up, but you're pulling all that money out. And so now it's whatever the cash flow is that's left over. Even though your debt payment's higher, it's free money basically. I mean, you don't have anything in the deal. Is that what you're saying?
Exactly.
Possibly.
Exactly. So, if you raised $1 million from your investors and, that it was 10 investors and they each had $100,000, and you gave them the option of, hey, we can keep this 12% cash on cash return. We're giving you 12% every year. We can keep that going, or we can give you all of your money back, but we'll give you a return that would equate to 8% on your investment. Mm-hmm. So they would say, wow, I get all my money back, so I can invest that somewhere else, and you're still going to give me 8% as if you had my money, and we get to keep the asset and pay down the debt and let it appreciate some more. They're going to be like, yeah, sign me up, do it. Mm-hmm. Because the property is paying for the debt. And even more, it's not income. Debt is not income. because you're paying it back. It's a loan.
Right.
No, that's a couple of beautiful points there that I don't want to skip over. Is a refinance allows you to take, depending on the situation, allows you to take profit tax-free and go invest it again. So, most of our deals, when I see money, I don't see, cars or stuff. I see a little thing that can generate more of itself. And so I think of money, it's like, hey, I can earn 15% a year on that dollar. So anytime there's an opportunity for me to borrow at 4% or 5% and go and invest that and make 15%, to me, that's the game of real estate that people need to be thinking about. It's a leverage game. And so refinance is a powerful tool to get tax-free money.
And you say it's tax-free because you put that money in and you're just getting that money back, so you haven't made a profit on it. Is that why it's tax-free? Or
it's tax-free because loan dollars, borrowing money is not a taxable event.
Okay.
So it's not income.
It's not income. Income is something totally different. But borrowing money from a bank, no matter how much you borrow, even if it's 4 times the amount you put in originally, it's not income, it's loan dollars.
Yeah.
And so loan dollars are not taxed. So you can get that profit without paying tax.
Okay. And that's nice.
Yeah. So a really good point we had in our last episode is the difference in evaluating debt and debt you can put on a property versus when you have it in contract and you're trying to buy it versus owning it in all cash and then putting debt on it afterwards. It's the same thing that you're doing in a value add project. If you buy something and it's making, a little bit of money or however much money, and you double the amount of income it makes, you can take that to a new lender and they're looking at it as a brand new property that they've never seen before. And they just evaluate it on the merits. As long as you've got trailing cash flows or, a 12 months worth of historic P&Ls, or sometimes they can even annualize, a trailing 3 month or a 6 month or whatever. They'll evaluate that and not only potentially give you all of your cash back, but potentially millions of dollars more because the property can afford to make the monthly debt payments, and it's a good investment for them as a lender because that's all they're doing. They're taking our money and they're giving it back to us in loans.
Right.
So
I'll try to give an example just so people that listening, they can kind of go through it in their mind. And maybe this is a big example, but they can pare it down to even a single family home that this can work on all of that. But, you buy something that's, struggling with occupancy. It's run down. It's been through a foreclosure. And so, we bought a deal in Indianapolis. It was just like that. The lender owned it and they're going to sell it for cheap. We take a risk on it. It had a lot of problems, but let's say we bought it for $2 million. And then we go to spend money on fixing it up, new roof and new parking lot and new paint and some new windows and all of that. And maybe that's $500,000. So now, we're kind of in at $2.5 million, but now we filled it up and the income is way higher than we bought it. So we took it to a new lender. And they said, hey, this is worth $6 million now. And I know it's a drastic increase, but it's a true example of what happened with the rising economy and the work that we did. So they said, hey, we'll loan you $5 million on this property. And so I basically owe $2.5 million. My loan is for less than that, but with the cash I have in, but they're going to give me $5 million. And it was like at 3.8% interest on a 30-year AM. So the income of the property more than covered the payment on that $5 million. And so I got to take that, my business partner and I, we got to take that $2.5 million. No tax-free. Wow. And we didn't sell the asset. There's no taxable event. We still own the asset. And so now we're paying down that $5 million and we're still making some cash flow over and above the payment. And that $2.5 million goes into a new investment.
Yeah, that's amazing.
And let's say I'm making 10 or 15% on that $2.5 million. Now it's an additional $250,000, $300,000, $400,000 in cash flow a year that we're making. And that's how valuable a refinance can be. And we still kept that asset and we have the new asset, and all without paying any tax. And so you get to invest that money tax-free and you get to roll it over, and then that new asset's producing cash flow and I'm investing that cash flow into the next deal. Yeah. So you're just think about this, guys. You're compounding interest in returns over and over, all before it gets taxed. Yeah. Right. But what happens with your job income or any type of tax income is they take 40%
immediately,
30%, 40%, 7.5% from Medicare. And then you spend whatever, and then you have this thing left over. And then if you go and make some money on a different type of venture, not real estate, you may have to pay tax on the income that you make, and it's cutting the income each time in the cycle, where real estate allows you to roll it and make those returns, and then invest those returns tax free, and then invest those returns tax free, all from that initial investment of that building, which was probably several $100,000. You parlay it into millions over the years. So that's the power of real estate and refinancing.
Yeah, I'll bet if you looked at that compounding of the example you just gave versus income, where you're paying all these taxes, I'll bet if you came up with an example like that, it'd just be incredible how much more money you could make doing it that way.
Yeah.
Other reasons to refinance, maybe you can get a locked-in rate, longer period of time. Maybe you can get a non-recourse, change it from recourse to non-recourse. Maybe you get a longer amortization schedule.
Those are all good points that we need to hit. First is you can drop your interest rate. If interest rates have lowered and you think they're as low as they're going to go, I would take advantage of that. And the costs are going to be minimal to the savings.
Yeah, you might pay a point. You might pay half a point of origination fees or whatever.
Real quick, I was going to ask about that. What are the costs? Real quick, just a new.
It's like you're doing a new loan,
a new appraisal, and just closing fees. Okay, just like a new loan. Okay.
But let's some people, when they're doing a refinance on a $125,000 mortgage, the closing costs are going to be. They can be $4,000, $5,000, $6,000. And so, man, it takes a little while to pay that back. But on a $5 million commercial mortgage, let's say I'm going to save a point in interest a year.
And you pay a point in origination.
Well, I don't know. I don't even think you pay a point in origination most of the time.
Okay.
You may, if you're using a mortgage broker to get a Fannie Freddie loan, but just a bank loan, you may pay a quarter of a point.
Yeah.
But you're saving $50,000 a year for that 1 point, and it may cost you, with appraisals and title work and all of that, it may cost you $15,000 or $20,000.
Okay.
So your payback is in 5 months.
Okay. Yeah.
Where that's not the case in a typical I'm going to refinance my house kind of way.
Right. Okay. Good point. Anyway, and I cut you off on the reasons. You started with lowering your interest rate.
Okay. You had said...
What else can you do?
Dropping off guarantee, going from recourse to non-recourse. That's really common. You can go in asking for that up front if you're going in with bank debt. A lot of lenders, especially local bank debt lenders, the loan kind of 10 years in. Once they see the financials on it for several years, once they're a partner in the asset with you. Like I said, they're the majority of the money in the deal typically. So, once they have it on the books for a few years and get to know you and get to know the deal, at 10 years in, and it's reasonable at that point to start dropping guarantee. Maybe you go from 100% guarantee to 75%, and then maybe a few years later it goes to 50%. Maybe it goes down to nothing eventually, right?
Okay.
I mean, you can step it down. It can go from 100% to zero, but just knowing you can ask for it, knowing it's a possibility is a big win. Yeah. And that's a question you need to know.
Yeah, and I have some thoughts on, we do a lot of non-recourse and recourse, and a lot of people are just so averse to any type of recourse. And I would say my advice would be make the decision more about the deal and about the cash flow and the interest rate than just getting rid of any recourse that you can, because we've converted some to non-recourse, and I wish I wouldn't have done that. Because the typical non-recourse is going to limit your ability to be flexible in the market.
Oh, right.
It can be harder to sell. If you have a good opportunity to sell to somebody, it can limit your ability to take advantage of moving interest rates.
Real quick, Brian and I were trying to buy a retail deal here locally probably a year ago, and the only reason we couldn't buy it, I believe, is because his loan payoff, he had to pay off his loan early, and we had to assume it, and we didn't want to assume his crappy loan. It was non-recourse. It was put on a long time ago, and he had to pay off over $500,000 in prepayment penalties before we could even come to the table. So that $500,000 killed the deal potentially.
Yeah. So just to circle back, that's a great point. So when I'm making a decision on going to a non-recourse loan, it typically is because the terms are better. Not because I'm just trying to get rid of my exposure or my guarantee. Fannie Freddie loan, those loans are just better than bank loans on multifamily,
right?
For example. So anyway, we do need to have a whole show on just debt, but we won't get into all of that today. One deal we're doing right now, we're refinancing. I'm on a 20-year AM and I'm taking it to 25. and I'm lowering the interest rate a quarter point. I already had a really good interest rate.
So you're hitting it from both ends on the debt.
Yeah,
payment.
and it's going to help increase cash flow, and there wasn't a prepaid penalty on it, and so it's just something that we can do pretty easy.
Yeah. So when you look at it, you have things that are above the net operating income line. You know, you have your profit, you have your expenses, and then you typically have net operating income. Below that, you have, you know, your debt service, and then your free cash flow to distribute to your investors. And really what matters is the free cash flow you're distributing to your investors. Mm-hmm. So if you spend it all in debt, then there's no free cash. But I forget where I was going with this.
Well, you were just saying, well, I lengthened the amortization and I lowered the interest rate. It's going to allow me more money to distribute to the investors.
Right. But you didn't make the property produce any more money. The same tenants were in there, but you increased your free cash flow that you're distributing to your investors. Right. And that was important.
Mm-hmm.
I mentioned locking in for a longer period of time. What are your thoughts on that? I mean, to me, it'd be a great, as good as interest rates right now, if I could go find a loan where I could lock in for, say, 10 years, I'd love that, I think.
Yeah, I agree. Now is a great time to be able to lock in. There's some people that get floating rates, and they don't mind. They get a lower rate today, and they don't mind taking that risk. For me, I really do appreciate having that fixed interest rate.
Kind of peace of mind.
Yeah, the peace of mind that comes along with getting a 10-year fixed rate when you know your cash flowing, because rents over time will go up.
Yeah.
And so if you can get a good interest rate and you know your payment isn't going to go up for 10 years, you know that you're going to be, you know, in a really good cash position in the future.
Yeah.
Now, you know, if you get a 5-year fixed, which we have to do on some of the retail deals, it's still good. But it, you know, as you approach 5 years, if rates are up 30% and you haven't increased your rents very much, then your cash flow could be taking a hit.
Yeah.
So the longer is always better, but especially when there's not a heavy prepay. You know, longer may not always be better if you're locking yourself in with a huge prepay, because it will reduce your ability to be flexible to the market.
Yeah. I would agree with that. What else?
I don't know. I'll tell you one thing that struck me when you guys were talking about this is, you know, you said always be looking at refinancing. I mean, almost from day one. Because when you think about it, we work really hard on getting the best debt we can. And if we get another 0.1%, we think, oh man, that's great. That's another tens of thousands of dollars a year in free cash flow. But then I think people's tendency is, okay, I got that done. The whole deal's done. Now I'm just going to kind of operate this property and let it go. I mean, I think you need to be thinking about it all the time. You might refinance, you know, within 6 months or something, I suppose, if there's a drop in interest rates or whatever. Some of these things we talked about could occur. So I think what you guys said about always think about refinancing, because it's the biggest part of the deal.
Yeah, we, you know, just when you're looking at a time perspective, you know, the amount of lenders you and I are meeting with is almost comparable or more than the amount of investors we're meeting with.
Yeah.
Because again,
spend a lot of time at that.
The lenders, you know, we've gotten way more money from lenders than we have from investors. And that's typically the scenario with most people buying real estate. Yeah. So when you focus on the money and where it's coming from, you know, it's a relationship and it's something to be monitored. And, you know, they're doing it to make money. And when you respect all of these things and know them for what they are, then I mean, it makes sense to look at it every day. It makes sense to look at it all the time, because if you can get your investors their money back, if you can save money, if you can lower your risk by going from recourse to non-recourse, you know, there's so many things. Right. Why wouldn't you want to look at that every day? That's your job.
More than just lowering your rate, right?
Yeah, way more than
that's
just lowering
minding your business. You have to be doing that. Yeah. What I'd say is, in order to take advantage of always be looking for the next refinance, is I want to give people a tip: is push back on your lenders on prepay. I have allowed lenders to put prepays on deals that we were doing purely because I thought, oh, at the time this is a great rate. I'm not gonna want to refinance. Yeah, right. And I got soft and I let them put the fee on there. Yeah. And I just paid 2 points, 2% of the whole deal to refi one of our deals. Now I still think it was the right business decision. Yeah. But it was really painful. And I just want to encourage you, the banks will bend on some of that, push back really, really hard on prepayment penalties when you're getting your loans. That'll help you have flexibility to take advantage of situations in the future.
That's a really good point, because just like you said, I'll bet most people are thinking, oh, well, I'm not going to refinance, and they're going to give me this great deal, and all I have is a few years of prepayment. I think a lot of people are thinking just what you said, that's not going to come into play, and when it really does.
Yeah, and you're not going to get it all on every deal, and some deals need lower rates. Some deals can afford a higher rate because they've got more cash flow. But you maybe want a longer AM schedule, or this multifamily. You can typically always get 25, 30-year AM. Retail and some other classes, you may be 15 or 20 sometimes, and that's a major difference on free cash flow that you're able to distribute. So
yeah,
I mean, it's a massive deal.
Yeah.
Anyway. It was a good episode. You got to focus on the debt. You got to focus on the majority of the capital stack. It's mitigating risk for you, the investors, and the idea of, hey, we're going to give you all of your money back, and we're still going to send you money, and we're going to keep this asset. We're going to pay down the debt.
That's the best case scenario.
Yeah, then you become a real estate collector.
Yeah.
Anyway, check us out on the internet, howtoinvestinCRE.tv, and we'll see you in a few days.